Hi, this is Michael King. Today we're going to talk about Introduction to Finance. We're going to talk about what finance is. We're going to compare real versus financial assets, discuss the financial system, the channels and different intermediaries, look at some financial instruments as well as markets, and briefly talk about global financial markets and crises. So when we talk about finance, what do we mean? Most people have in mind money. Finance is about how we manage our money. In the textbook by Booth, Cleary, and Rikita, they call it the study of how and under what terms savings are allocated between lenders and borrowers. Now, it may be that it's a lender and a borrower, which has a creditor relationship, or it could be a saver and an investor. There are various fields of finance. Looking at individuals or households, we call it household finance. Looking at the government, we call it public finance. And looking at corporations or businesses, we call it corporate finance. This course is focusing on corporate finance. When you study finance, you need to understand what the financial securities are, such as stocks and bonds. Who are the players? What are these things called financial intermediaries? Well, they're banks, brokers, or other types of asset managers, such as mutual funds and pension funds. We're going to be looking at different types of financial markets, both the primary issuance and the secondary trading. And we're not really going to talk about it, but underneath and helping the operation of these markets is the infrastructure, such as exchanges or the over-the-counter market. So, just to recap, a financial security is a type of instrument or a contract that has a claim on cash flows. It could be a stock, could be a bond, or it could be a derivative. We typically classify assets into real assets and financial assets. So a real asset is something physical or intangible that generates value for a company. Could be a building, could be a piece of equipment, but it could be a piece of intellectual property. The same is true for people as well as for the government. We have lots of different real assets, such as real estate or the infrastructure, such as roads and airports. When it comes to financial assets, we're talking about a contract that provides a claim on cash flows. So you can think of a very simple claims, such as when you put money into your bank, you have a deposit which has a claim on that cash. You could invest the money with the bank for a limited term in what is called a guaranteed investment certificate. The bank may make a loan to you or extend a mortgage, which are two different types of credit. Or you could issue a bond or take out a loan if you're a company. We also often talk about stocks or equities or shares, which imply ownership in an underlying asset, and an option is just one type of derivative. So when we look at Canada and the households, we see that the vast majority of assets are real assets and financial assets, split roughly 50-50. So you can see that housing and real estate are worth around $2.4 trillion in our national accounts. Land is another $3 trillion, and real assets are around $6.2 trillion. When it comes to financial assets, we have a lot of money sitting as deposits in bank accounts. There are also debt instruments that we own and hold. We have money saved up in our pensions and insurance plans, and we hold equity either directly or via investment funds such as mutual funds. So our total financial assets in Canada was about $7 trillion back in the third quarter of 2018, for a total on our balance sheet of $13.3 trillion. Set against that, we have consumer credit, loans, mortgages, and other liabilities that add up to around $2.2 trillion. So our net assets, meaning our total assets minus our total liabilities, are $11.1 trillion. We could also call that our net worth. The financial system itself is made up of the three different types of players: government, business, and households, as well as non-residents who are foreigners that are investing into our markets. When we talk about the financial system, we're really talking about how money is transferred or channeled from households ultimately to these three different types of borrowers, or they may be invested in those companies. We see that governments and business are the biggest borrowers and households are the biggest savers. Now the money can either flow directly or it can flow indirectly, and the process of having the money flow through some intermediaries is called financial intermediation. So there are actually three ways that money flows from people who have savings, such as lenders, to people who need the money, such as borrowers. We have direct claims, which may be of one type non-market transactions. So I can invest directly in a company without having to go through a financial intermediary. We could also have go through market intermediaries, such as a specialized firm, such as an investment bank, a broker, or through infrastructure such as exchanges. And these intermediaries may be actually acting as an agent, meaning that they charge us a commission to bring the lender and the borrower together, or they may actually be acting as a principal, which means they purchase the security and then sell it and hold it in their inventories. Lastly, we have indirect claims, which will flow through financial intermediaries, where a financial intermediary is a specialized entity that collects the funds and will manage it and invest it, such as a bank when it takes a deposit and makes out a loan. There are many different pictures that you can find on the internet of a financial system. Here is one showing the flow of funds either through financial intermediaries or through financial markets from lenders or savers to borrowers and spenders. Here's another more complicated picture that looks at the US financial system. Again, you can see the familiar pieces that we've talked about. We see financial intermediaries in the bottom, we see financial markets at the top. On the left, we see lenders or investors. On the right, borrowers and issuers. The actual securities themselves are called financial instruments, which could be loans, securities, etc. And we see all sorts of different groups on the outside that provide both regulation as well as standards. They may be associations, such as the accounting associations or the industry associations. And these are all different actors in the financial system. So let's take a closer look at a few of the main types of financial intermediaries. We have banks, credit unions, and trusts, which collect deposits from households, individuals, and they may also borrow in the markets, and they use these funds to make loans. Now, you could be a retail bank, meaning that you provide loans only to individuals. You could be a commercial bank where you provide it to a business, a mortgage bank that provides it specifically for the purchase of property or real estate. Insurance companies are another major financial intermediary. There are many different types of insurance companies. You may think of auto insurance companies, personal and commercial insurance, life insurance, amongst others. And all of them are selling a policy that will pay out in the event that something happens, an accident, a fire, or the death of a policyholder. Whoever holds the policy will then collect on that policy, which is a claim that will be paid out by the insurance company. Pension funds will collect savings from individuals and pay them out in retirement. There are two main classes of pension funds, what are called defined benefit and defined contribution. Defined benefit is where you basically receive a pension benefit when you retire based on the years of service and your average salary in your final year or perhaps your final 5 years. Defined contribution has become much more common. It's where we contribute into the pension fund along with our employer, and then we have to invest it, and whatever money is available at the end belongs to us. We have various forms of asset managers that pool money from different investors, such as mutual funds, hedge funds, and other types of asset managers. And there are many different types of financial intermediaries that you may be aware of: private equity firms, venture capitalists, wealth managers, amongst others. So there's two major types of financial securities that we'll be talking about: debt securities and equity securities. Debt securities are usually have a different name depending on who is issuing them, as well as the maturity. So the government may issue treasury bills, which are 1 year or less in maturity, or they may issue government notes and bonds, which are longer term. Businesses may issue commercial paper, which is less than 1 year in maturity, or a business may also issue a bond, in which case it's called a corporate bond. We have loans, which may be unsecured, meaning that there is no collateral that is specifically tied to the loan, and we have loans that are secured, such as a mortgage, where the actual loan is backed by a claim on the real estate. When it comes to equity instruments, there's two major categories: common shares and preferred shares. We're going to spend quite a bit of time talking about both of those, but just be aware the common shares represent ownership in a business, whereas preferred shares simply give you a prior claim on dividends. Now, any of these instruments may be classified as marketable or non-marketable. We can have publicly listed equity, but we can also have private equity, which is not listed and is therefore less liquid. Financial markets themselves are divided into several types. We're going to focus mostly on primary and secondary markets. Primary markets is where new securities, both stocks and bonds, are sold directly to the public or to institutional investors, and where the sale of that security, the cash that's received, goes directly onto the company's balance sheet. A secondary market is when a security has already been sold and is outstanding and is trading between one holder versus another. You may be trading against a large institution, and when you sell a stock, you will receive the cash yourself. It does not go back to the company whose stock you sold. There are other markets called third and fourth markets, which tend to be less liquid, smaller, and typically for unlisted securities or over the counter. Now, trading can take place in two types of secondary markets. It can either go through an exchange, such as the Toronto Stock Exchange, the Montreal Exchange, or the New York Stock Exchange. These may also be called auction markets. Or it may go through a financial intermediary, such as a dealer. Or you could trade directly over the counter with your counterparty. One pension fund could trade directly with an insurance company, for example. Lastly, financial markets are prone to crises. We see often that because these markets are large, global, and liquid, that crises occur on average about every 4 years in different parts of the world. And here you can see some of the more well-known ones of the past 20 years. The largest one in recent memory was the 2008-2009 global financial crisis, or the GFC, which originated in the US subprime market and then spread. Basically, subprime mortgages were mortgages that were given out to borrowers who had low income and no collateral other than their house. And when they were unable to pay, service the mortgage, they defaulted, and the mortgages themselves, which had been packaged and sold, were then defaulting. And you can learn all about this by watching the movie The Big Short. Although it started in the US, it quickly spilled over into Europe, both the UK and continental Europe, with many banks who had been holding these US subprime mortgages suffering major losses and having to be bailed out. This global financial crisis was followed by a long recession known as the Great Recession, but it also sparked a problem with European sovereign debt, which became known as the European sovereign debt crisis, where countries such as Greece, Ireland, Portugal, and others had to be either bailed out or rescue their banks. Here you can see, you may not have appreciated this, but many of the largest financial institutions around the world were actually bailed out by the governments. In the United States, that would include JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup, the 4 largest banks. And you can see it was true for most large banks in different parts of the world. Okay, that's it. A whirlwind tour, and look forward to seeing you again.